Alrighty, so today we're going to go through chapter 8. I'm going to start off with today's passcode is E equals mc squared, Einstein's relativity. I always liked this. There's some scientific and philosophical reasoning behind what this equation means, but I just like the fact that it means that with enough energy, in theory, someone could go travel at the speed of light, which, and going back to the Beatles songs, if it's possible, then that just means someone hasn't done it yet. So it's kind of anything is possible with enough effort. And the reason that that's important today is because of the fact, I don't have my video on, you can't see me. There you go. Is I graded the midterms over the weekend. Right now, what you see in Blackboard is without the curve. There will be a 4-point curve. Each of you get the individual grade. I'm graded on the average. I'm not really happy with the average, even after the curve. And as I was going through it, majority of the points were deducted just because of a lack of effort. On the multiple choice, yes, the questions were construed in a certain way. If you went into the test speaking English, you weren't going to get it. The point was to translate each of those questions and look at the problem to see what was going on. Those that got so on this multiple choice, I'd say the average was about a 75 to 80. If you got the question wrong, go back and look at why you got the question wrong, because when I made the questions, I didn't just pick the right answer. I went and picked the wrong answers. And so each of those wrong answers is because of a particular error. So when you did the test, if you just did your math and was happy with the first answer, that's probably why you got it wrong. Take your time, think about what I'm asking and what the difference is. Even with that, I figured you'd get better. The two discussions, all you needed there was effort. I accepted either of the answers for the stock as long as you gave me a coherent reasoning. And some of y'all just decided not to do that at all. On the other one, it was more just, can you follow directions? Can you go to a website and do what I tell you to do and form a coherent response? In terms of the problems, 2 of them were straight from the book. One of them, you could have looked at my video of me doing it. So for those that weren't happy with the final, I wasn't either. The final is going to be in the exact same format. Some of those same questions will show up. And yeah, that's my soapbox for today. Another thing is, this is a digital signature. I put it in capital letters for a reason. Simply typing your name is not a digital signature. Signing it and scanning it in defeats the purpose of a digital signature. I've had to use these more often than not, so that's why I added it in there. The fact that it was capitalized in the instructions should have given you a hint. Yeah. Alrighty. So, questions? Sorry about my soapbox, but that's where we're at.
We want to talk about the sales and repurchase agreement, and then regarding the signature part, it said you had to like attach something.
So attach a digital signature.
No. When you press it, it was saying you had to do something special with like ID or something like it. I don't know if that's covered. So I didn't
Yeah, you have to have what it is this little piece at the bottom.
Okay.
and it's a digital certificate.
Okay.
And yeah, you just hit yes, and it connects. What it does is it picks up your IP address and it says, someone at this address signed this document at this point in time. It also locks the document to where any further editing on the document kicks off the signatures, which is very important when you're sending documents back and forth. It's not that big of a deal. So you got 2 points off if you didn't give me an honor statement at all, and you got 1 point off if you didn't give me a digital signature. But you're getting a 4-point curve. So, alrighty. You missed the E equals MC squared is today's passcode. Okay. So this week is about inventory. I really wanted to pick this picture out of the text because you have an entire class on this picture alone. So your managerial accounting is nothing but this picture, going through all sorts of ways of calculating, but it's good to see it in this workflow, because as you progress, we're going to make it more and more complicated. So in principles, all we told you was that in calculating inventory, you have FIFO, LIFO, and weighted average, which is true, but all of that only accounts for the raw materials. And you're going through all of those calculations to calculate what your balance of raw materials is. But raw materials itself is only 1/3 of actual inventory. And more often than not, it's the least costly of the third. The next biggest is labor. With labor, you need to figure out which labor is actually a product cost versus a period cost, which is the next slide, or 2 slides for now. But you have to figure out exactly how far attached that employee is from turning the raw material into a work in progress. So the actual laborers that are there on the job building the widgets, they're going to be directly included. Their managers, supervisors, anything like that is going to go to overhead. And then if you're more directly on the sales side or corporate, those are going to be your period costs that exclude from here at all times. The benefit of going through this analysis is because of the fact that you're not going to sell all of your inventory that you produce in that period. So effectively, even though you're incurring the cost of labor, you're incurring the cost of overhead, you don't have to expense it right away. Part of that is going to get caught up on the balance sheet. And so that's the benefit you receive here, is that your EBIT is looking better. However, the higher your EBIT, the higher your taxes. So there's also a incentive to push all of those costs out of this picture and straight into your income statement. So that's why we're gonna look at that. As I said, managerial accounting, you'll go into exact details. Here, we want you at this point just to learn the overall flow and the formulas. Okay, so with the raw materials and the labor and the overhead, know that the journals, these are all you can consider suspense accounts basically. So as the actuals come in, you're going to be, that's on the debit side. So these are all suspense accounts within the inventory. So you make that purchase, that FIFO purchase, that LIFO, that's going to be in the debit side. As we use these up, these are all inventory accounts, sub-inventory accounts. So when we use them up, we're decreasing an asset. To decrease an asset, we credit them. And we're going to push them all from here into the work in progress. So that's the debit side of that. And then as we get to completion, we're going to move to the finished goods. So again, in managerial accounting, we're going to complicate this even more. We're going to tell you how to calculate what happens when we're 75% complete. There's going to be some more moving it in and out from here. But at this point, suffice to know, raw materials plus labor plus overhead creates your work in process. Once it's finished, you then credit it out of here and you move it into finished goods. Okay. When you're in finished goods, you're going to have the goods that you had at the beginning of the period. You're going to have all the goods that you finished that period. That's going to create what's called the available for sale, goods available for sale. And then from there, it has to either go to cost of goods sold or now our new ending inventory. So again, this is a good picture. And as we're going through the journals, as you're going through the problems, picture yourself actually in this graphic and walk it yourself along the lines, noticing, and again, these are T accounts. They put it that way on purpose. The debit side is how we get the increase. The credit side is how we decrease it. And you can see as we decrease this side goes up. As we decrease this side goes up. Okay, makes sense? All right, so the differences on timing. Now, more and more people are getting into the perpetual cycle because it's a lot cheaper. Used to the first time you got a perpetual was with the RFID scans, now the little barcodes. Now they have tracking where on your credit card they can tell you exactly within 5 feet of where you're standing. So because of that, it's a lot easier to keep perpetual records. Some of the periodic records, they act like perpetual, but they still require an ending count because you're not actually tagging the inventory, you're counting sales and stuff. So you're kind of backtracking into that. As you go through the problems, the only difference between here, the perpetual and the periodic, is when the accounting information system is updated. Okay, so when you're going through the FIFO and the LIFO calculations, you have to put the dates of each of those transactions in line, and then you decide which costs based off of that. When you're on perpetual and periodic, it's going to change when some of those costs and the sales are coming in. It's not going to impact the sale or the purchase of these costs because that's based off of your AP. But it will impact on the sales side. And the way you just ask yourself is the perpetual, you can put it that day, the sale happens that day, whenever the sale is. On a periodic, the accounting information system won't pick up that sale until the end of that period. Okay, so all your purchases on your LIFO and FIFO calculation will come in when they come in, but your sales will only be calculated once at the end of each month. Okay, so that's going to be a little bit different on your problems. I told you we're only going to learn algebra in this class. When we're talking about inventory, this is the only formula you need. And this is really the only formula you need for anything that we talk about, is your beginning plus additions minus subtractions equals ending. Okay, very simple formula. But you would be surprised how many times the textbook and the future textbooks can complicate such a basic formula. Here, we complicate it by saying the beginning inventory plus your purchases equals goods available for sale. Again, all we're doing is taking that formula and creating just an interim. Beginning plus additions equals goods available for sale. And all that means is at the end of the period, this is how much goods we had ready. It's an interim step in this calculation. From there, we'll take the subtractions, and subtractions for inventory. The only reason we subtract inventory is because we sold goods. Now realize, using algebra, I could trade these out. I can say goods available for sale minus ending equals goods sold, or goods available for sale minus goods sold equals ending. In the problems, that's what they'll do. They'll give you 3 of these 4, and you'll have to figure out the 4th one. Now, they might not make it obvious, which ones, again, the periodic versus perpetual. When are these purchases? When are these sold? These goods sold? Working through that formula. But at the end of the day, this is algebra. They'll give you 3. You got to calculate the 4th one. Okay. Also, again, this is only going to be for the raw material side of it. You'll have a similar calculation, but all of the labor needs to get applied to and all of the overhead needs to get applied. That's the only difference, is that you won't have labor and overhead in the transition accounts. When we get into managerial accounting, you'll figure out how it gets applied to a particular project and what happens when you get over or under applied. But at this point, just know labor is one of the components. All of the labor for that period gets added to work in process and then becomes finished goods. Okay. Any questions on the formula?
So you're saying only account for raw material when we're doing formula?
I'm saying this formula is for raw materials.
Okay.
Because labor, you don't have beginning or ending labor. You don't have beginning or ending overhead, because those are product costs for that we're just attributing to the inventory. Okay, so before we get too far into the calculations, always a good chance to check in with our legal team. So realize this class is about financial statements. And this chapter is about the inventory registered on that financial statement. The question you have to ask yourself is, what do we include and what do we exclude? And the answer becomes simple when you talk to legal, because the definition that we use is we're going to include anything that is legally ours as of the date of our financial statements. Okay, so what that means is goods in transit, you have to go back to your FOB shipping, FOB destination. When does the legal economic benefit of that good transfer? Either we're the ones shipping it or we're the ones receiving it. When at the moment that the goods transfer services, then either I have to include them on my inventory or I'm no longer able to include them on my inventory. So a lot of tax evasion has gone on with the goods in transit, because you get the joke of the mobsters putting the stakes on one truck and then driving it around to the neighborhood. You know, if it's in transit, who does it belong to? Well, the answer is based off of who still owns that goods. Okay. There's a lot of during an audit, you'll have to test, which goods left the factory. Were they included in that year's sales? Should they have been included? If it's FOB delivery, did the truck actually get to its destination by midnight of 12/31, or did the truck driver have a New Year's party and then go? Again, you have to check these things. If they're trying to push those sales within that last period, there's always a higher risk of that. Co-signed goods, Walmart's the biggest textbook example. So if you don't know by now, Walmart doesn't own anything in its stores. It actually doesn't. Walmart won't purchase the goods until you actually scan it to purchase it yourself. And at that time, Walmart basically creates the sale to you and communicates to its supplier, hey, this good was sold, we now owe you this amount. It's a co-signed good. Walmart has it in their possession, but they are not legally responsible for it. Walmart is just there as a marketplace for other goods. So under that definition, if I didn't actually sell it to you, I just co-signed it to you, then it's still my inventory. So I need to record that on my inventory, and you're not allowed to record that on your inventory. Okay, then we get into these special sales. So Walmart has a 90-day return policy. If 75% of their sales get returned, then you don't really have legitimate case of saying that that sale is final. So you need to make allowances and estimates for what the, again, if 99% of it goes through, we'll go ahead and record 99% of it, but you need to have that, you need to hold that liability for any case of those returns or those repurchases. And again, they go through the gross method or the net method. Within 90 days, it really doesn't matter. At the end of the day, the sale, the net effect is going to be the same. So it's just a matter of how your accounting information system is set up, whether or not you do the gross or the net. But either ones are acceptable. But what's not acceptable is you get to year end and you haven't accounted for these, especially if it's a significant portion. That's when we look at, again, it used to be a big deal, especially with all of these like the vendor rebates and things like that, where someone would order 10,000 bottles of Coke on midnight of December 31st, and then on January they would return 9,990 of them. They used to do that to inflate that year's numbers, but at the end of the day, it just that return comes into next year, and then you're taking next year's profits into this year, and so we try to limit that as much as possible. Okay. Any questions on that part? Again, the look at what is accounting will follow the legal definition here. If the inventory legally traded hands, we're going to account for that sale. Okay, so let's say that I have a fleet of the demolition vehicles for the hurricane. Okay, I have one option of renting them to you, or I can sell them to you and guarantee you that in 3 months I'll purchase them back at this rate. Okay, so if there's a built-in repurchase agreement, then that's not really selling it. Okay, so there's a difference between what I would record from a rental lease agreement perspective versus what I would record if I completely sold you that vehicle and then bought it back 3 years later. Okay, so if there's a built-in repurchase agreement and it's more likely than not that it's going to be repurchased, then we're not going to include that as a sale. We're going to account for that under specific guidelines of a lease back arrangement. Does that make sense? Again, the repurchase is more on the bigger vehicles, buildings, equipment, because that was kind of how those services went about. Like you really would purchase the John Deere for the 6 months you need to farm, and then you'd sell it back at the end of the year. And because of that, these companies would have really high sales at the beginning of the year and then really bad negative sales at the end of the year. So we've tried to smooth that and call it what it is. Okay. So the definition of the title is the cost-based approach. We are trying to figure out what is the cost of inventory. Again, so far we've complicated just the raw materials, and the fact is that even just the materials, you're going to get costs at different times, and therefore different inflations are involved. I won't go into the LIFO, FIFO specific and weighted average. I thought about doing Wednesday, but instead I'd like to do general Excel training on Wednesday. So I'm not going to go into LIFO and FIFO on the calculations because that was done in principles. But the thing to note is, again, this is calculating what the materials cost is. Nowadays, so LIFO used to be the go-to. Everyone wanted LIFO because of how big of a tax. That was your 60s, 70s, 80s mindset, because as companies got bigger, their inventory got bigger. If their inventory is getting bigger, LIFO is the better approach. And then companies like Amazon and Walmart and those companies came in and said, we're going to have zero inventory. Well, when you have zero inventory, the difference between LIFO and FIFO go away. If you're actually in a reducing your inventory cost, so Walmart is constantly pressuring, instead of making it for $1, trying to get 99 cents, 98 cents. Then FIFO is actually doing the exact opposite of what you want you to do. So if you're getting better and better terms with your vendor because you're helping them build their vendor supply out, again, think of Procter & Gamble, think of your big warehouse manufacturers. They've spent the last 30 years making every single penny count. In that case, FIFO is actually creating a higher inventory value. So that's what the chapter was initially talking about, switching from LIFO to FIFO. But again, go through these calculations and go through the fact of, if you're using these, how does periodic and perpetual come into play, and work through those calculations. Product and period, I told you when we talked about income statement, it'd be a big deal. Again, the fact, if it's product, that means it's for the inventory itself. And as you can see, inventory gets split between your income statement of cost of goods sold and your balance sheet of ending inventory. So because of that, we're going to be a little bit more picky about what we call product cost, and there's going to be a delay in recognizing that cost on the income statement. What's in a period cost needs to flow through to the income statement directly, and you're going to have a lot of questions of which one's which. But the treatments really are night and day. So yeah, any questions on that? Again, discounts, they give you the gross and the net method. The only difference is do you record the discount at the time of sale, or do you record the discount at the time of the cash distribution? It's going to be based off of which one your company ends up doing more. If you get that discount often, you're just going to record it at gross, so that way you don't have to worry about the subsequent adjustment. If you don't, then you'll record it at net. Okay, make sense? Okay, so because LIFO is the biggest one, we wanted to talk about the issues that come with LIFO. So they talked about how there's the LIFO reserve, which is, simply put, the difference between FIFO and LIFO. If you were in that increasing inventory, increasing cost, you ended up having a higher value in your inventory today than what it would be if you followed the FIFO method. Okay, well, there's questions now because the income statement is fine. We've sent that off. But the balance sheet is where we look towards future growth. And if you're including this number in your inventory, and your inventory we use to calculate your inventory turnover, your current ratio, all of those numbers, the question is what you're reporting really accurate? If you're using the last in, first out method, then it means the balances on your balance sheet are from 5, 10, 20, 30 years ago. And so the question then is, if you were to use FIFO, what would have been your inventory? And using the conservative approach and the more relevant approach, we're going to go ahead and make an adjustment today to show you that decrease in inventory. Okay. So again, the LIFO reserve, and it's only on your financial statements. You're not going to tell your IRS auditor this number, but on your financial statements, in order to have your balance sheet more representative of current figures, you're going to do that LIFO reserve and therefore decrease that amount. Okay. The LIFO liquidation, I told you the benefit of LIFO only exists if you're in an increasing inventory, increasing cost situation. As soon as you realize that there's a carrying cost to your inventory, I have to pay for a warehouse, I have to pay for security, I have to pay for climate control, I have to pay per square foot of these boxes that effectively aren't doing me any good, except for having me prepared for this future. Now companies are, especially now, but even in the last 5-10 years, companies are going to that just-in-time inventory, zero inventory held. Amazon doesn't purchase it until you make the sale. Walmart doesn't purchase it until you make the sale. Inventory is costly, so they're getting rid of it. Well, now as you get rid of it, you're pushing that cheaper inventory into your income statement, and therefore you're going to end up that it's just the opposite is coming through. So you receive that tax benefit for the first 10 years, and now you're going to end up paying more taxes over the next 10 years. So it's just a very particular situation that companies are finding themselves in. And investors are calling people out for using the LIFO method. And so investors know of this situation and know that so what I'm trying to say is companies are achieving a higher synergy value by reducing and making their inventory more efficient. That is a known benefit that they're going through. Investors know that in order to get to that point, they might have to deal with this situation that comes up. And so they're reassessing the value of the inventory on the balance sheet because they know if they switch to that leaner, more cost effectively. And again, think about the midterm. If the company's sole purpose is to go in there and derive a benefit based off of reducing inventory values, well, this LIFO liquidation is going to hit, and therefore, at least without taking a big write-off, they won't get those adjustments. They won't get that accounting earning if they do. Does that make sense? It's become a bigger deal now. And then there's the dollar value of LIFO, which is another way of calculating. Again, after this slide, you really won't hear LIFO, FIFO anymore because we're going to focus on the other 2/3 going forward. So that's the chapter. The last one is the impact of errors. Again, you should be learning this as a language. This picture should be what you see when you go to sleep at night. And therefore, if I tell you we made an error here, you should know what the impact is to here or to here. Okay, and that's what accounting is going to do. Is we're going to tell you all of this information, and then we're going to complicate it, and then you're going to have to go through and ask yourself, okay, if I miscalculated my labor, I miscalculated my work in progress, I miscalculated my finished goods. So when I correct my finished goods, what impact is that to cost? If I mislabeled something as a period cost when it should have been a product cost, what happens to this picture? What happens to my income statement? What happens to my balance sheet? What happens to 2001 versus 2002? Okay, so that's what I mean. You need to be able to see this in your sleep, is that any impact in this account, without even asking, is second nature of what happens to the cost of goods sold. And so there's going to be problems like that of this happened, how do I fix it? Okay. So any questions? Again, that's the chapter. I planned on 10 minutes of lecture time, but I didn't want Jamila to get the brunt of my disappointment. Okay, so like I said, Wednesday, I'm going to present the same Excel training that I presented at both my PwC and my work, my current work. So we'll learn some pivot tables, some sorting, some filtering. If you have mobile Excel, bring that so y'all can play along. The goal is just to show you how to manipulate big set of data. The reason why is because literally right before this phone call, on a call with the CEO, I had to tell somebody how to create a pivot table. So hopefully y'all won't ever see that. So that's going to be Wednesday, and I hope y'all get a lot about it. Other than that, y'all have a good day. Again, grades are out. The grades that you see is before the curve. I probably will just manually add the curve when I calculate your final grade. Okay. Y'all have a good weekend. Or sorry, today's only Monday.